However this ends up, gold is still going to be around because it's been around forever. I can redecide what I want to use my gold with at the other side of the tunnel. But right now, while I'm in that tunnel and I don't know where it ends, gold seems like a pretty safe place to put your money.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter Markets are here.
Welcome back to Gold for the 21st Century on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. Our guest today is Don Casturo, Founding Partner and Chief Investment Officer at Quantix Commodities. We'll be discussing the role of gold in protecting investors' portfolios, the drivers of recent gold market performance, and how de-dollarization is changing the way gold trades relative to other assets. Hello, Don. Welcome back to Smarter Markets.
Thank you, Dave. Great to be here.
Well, it's great to have you here. So far on this series, we've been discussing the role of gold in the financial system, and I'm glad to have you here with us to talk about the role of gold in investor portfolios. As people will remember, you're the Chief Investment Officer of Quantix Commodities, where you provide investors with commodity investment products designed to protect their portfolios from inflation. And I was curious, how much interest are you seeing from investors in protecting their wealth from inflation? And how has that been changing since you started Quantix? I think that's about 6 years ago.
Yeah, it's been a bit of a roller coaster over those 6 years. We were on to the theme of inflation becoming relevant again after years of basically irrelevance with how low inflation was for over a decade. But we felt that we were at the end of the economic cycle where such output gaps were going to be decreasing, and then we're going to see some pressure on the commodity sector in particular that could lead to inflation. And indeed, coming out of the pandemic, that was definitely the case. And there was quite a bit, as you're well aware, of inflation fears, not only in actual CPI numbers, but inflation fears that were running rampant in 21 and 22. Those kind of were put on the back burner a little bit for the last couple of years, but we're definitely seeing the reemergence of inflation fears. Now you can see it in consumer expectations of inflations being as high as they were even back then. And we're hearing it amongst our investors that inflation definitely is a concern once again.
And I know your approach, you tend to distinguish different types or sources of inflation, whether it's, you said, output gaps tightening and economic cycle pressure versus currency debasement. How are you thinking about that in the current environment?
We aim to provide commodity inflation protection on a broad basket sort of level. So I know this series is focused on gold in particular. Gold plays a very important role in our approach, but not the only role. I mean, we're by no means precious only fund. We're a broad basket commodity fund, and we feel the best form of inflation protection sort of incorporates the whole commodity spectrum, because in my discussions with investors over the years, and my belief personally, is that there are different sources of inflation that matter to investors and that when investors are concerned about it. And that comes through conversations with them. Many of them would say, should I buy oil or should I buy gold? And it occurred to me like, wow, those things have completely different characteristics. How can investors think they're both appropriate as inflation hedge? The reality is it's the different forms of inflation that they're worried about, which is why we think a dynamic reweighting of a broader commodity basket is probably the most appropriate approach. And that's what we've implemented with the way we've created our long-only basket commodities. But basically, the premise is if you're in an environment where inflation is being driven by a deficit in things people consume, you're going to want to own those consumable commodities, because the only way to address that is to try to encourage more supply or less demand by raising the price of those consumables. If the thing that's driving inflation is a general store of value, I think everything's going to cost more a year from now. And most commodities, certainly all the ones that we would trade in the liquid benchmarks, are denominated in US dollars. So that's particularly the case. If you think the dollar is going to have less purchasing power, you want to look at the commodities that are a good store of value, and that's where gold fits in. Now, you mentioned the word debasement. That's how when we originally came up with this framework, we were describing this wave rating process through the lens of scarcity versus debasement. We've sort of broadened the definition of debasement now to include de-dollarization, because I think that's more of where the driver of wanting to look at commodities, gold in particular, as a store of value is coming from that than rampant money printing, so to speak, that it might be characterized just solely by the strict definition of debasement.
And I'd love to go into that de-dollarization piece a little bit, right? Because it's one of those things that people have talked about for decades, and then you don't see it and you don't see it. But I think many people think this time might be different. Is that the sense of the conversation you're hearing?
Yeah, absolutely. And I think the interesting things that have been happening in treasury markets sort of tell you that there's something to this de-dollarization thing that's more than just gold prices rallying and central banks buying a little bit more than they historically have over the last couple of years. If it's a company not only by buying gold, but you're actually even seeing signs of selling treasuries, the implications for gold could be enormous in that respect.
Yeah, and I wanted to ask you about that. Could you go a little bit more into that, what you're seeing with how gold is trading against other assets like treasuries or dollars? Is that changing relative to previous patterns?
Absolutely. Many gold market observers, banks have put out models. Historically, you could fairly accurately, with a high regression coefficient, model the price of gold off of real rates. And obviously, inversely correlated, the higher the real rates go, the lower gold should go, and vice versa. Those models have suffered and don't really work well at all over the past several years. Basically, since the Russian invasion of Ukraine, US response to that was to use the dollar as a weapon. And not only when it was Russia concerned about that, but other central banks seeing that the power the US may choose to employ as the world's reserve currency by using the dollar as a weapon has sort of moved those central banks in the desire to move away from that. And even when you saw real rates rising while the Fed was raising rates in the last episode, gold continued to rally, and that historically would have been unusual, but that is a very telling sign, I think, as to what a new input into the modeling of gold price needs to include, which is this desire to move out of dollar assets into something more neutral, the countryless currency of gold.
And I know you've said you have a broad basket of commodities that you use to help provide inflation protection. How do you see gold's role in that? And how much gold do you put in that portfolio?
Well, a key feature of our process is this dynamic reweighting. Like I said, it's not a static weight that gold holds X amount over all time. And we have some proprietary signals to try to identify what is the bigger driver, whether it is the scarcity or debasement element. And that actually takes the gold weight somewhere in our modeling, anywhere between 5 and as high as 50%. So it can have a very wide range depending on what our signals are telling us where we are.
You able to share where you're at now?
So we're closer to the higher end of that range. The majority of the signals are telling us it's a better environment for gold than the consumable commodities, not at the max weight, but towards the higher end.
Fair enough. And I know you approach gold from more of a macro trading perspective. So I wanted to ask you, how are you thinking about the way gold's been performing in the context of the broader macro environment?
It's outperforming basically every other asset year to date. Even over the past couple of years with phenomenal equity performance, gold has pretty much kept up. So I think every investor has to seriously consider at least some allocation, maybe not as high as our quantitative commodity basket has for it, but at least some allocation to gold makes sense on just relative performance basis.
It's pretty amazing to think, given the strength in equities in recent years, that gold's kept up. Have you seen that before in your career?
No, no. As I said, I think that's a very telling statement in terms of the global mindset of gold and how that has shifted.
When you look across the type of people, I don't know how much visibility you have into it, but do you feel like new and different types of investors or banks or central banks are participating more in the gold market than they used to?
One of the things that is on in our investors' minds that is a fear that they may have missed out, like because gold is at all-time highs and the size of the daily rally seem to be outsized relative to historic moves, that it's a sign of a speculative bubble. And one of the things I tell those investors, I think that they should be much more concerned about that if the buying was coming from the majority of the buying, and the reason we were at this levels was purely from the speculative community, because that speculative community tends to be a little higher frequency, is sensitive to pullbacks, and maybe has risk metrics that force them to reconsider and rebalance their portfolios on a stop loss sort of basis. But given that the primary buyer that has emerged and has changed the models for gold pricing that I alluded to earlier has been central banks, their modus operandi and trading dynamic is completely different. As we've discussed in the past, they invest and divest on decade-long cycles. And we're in the very early innings of this central bank asset reallocation. And if they were the primary buyers, if they wake up tomorrow and gold's down $100, for example, they're not going to panic sell. I feel quite confident they're going to want to buy more in that scenario, which I think makes it a much more stable rally than something you might have seen in the past where commitment of traders is showing excessive gold length, or the ETFs at all-time record highs, neither of which are the case, by the way, either. Though I will make one comment on that I think is overlooked by a lot of people. Yes, ETF and managed money length from a contract or ounce basis is not even at all-time highs, and it's above the 50 percentile. On a dollar notional basis, it's at all-time highs. If you're looking at it in ounces, it doesn't seem that stretched. But when gold prices are twice what they were the last time ETFs were this well owned, obviously that means there is a lot more dollar ownership.
Are you seeing a response in the physical market? Like, are the physical buyers having to back off at these higher price levels? You said the central banks are still in.
Jewelry demand is off a bit. And so when you say physical buyers, gold is not really consumed. I mean, it's you could argue jewelry isn't even consumption too, because that can be resold and scrapped back into the market. Jewelry demand is off a bit and scaring some of those investors away, but it's overwhelmed by the amount of central bank buying that you're seeing. And what I think is encouraging for the gold story, though it does introduce a little bit more $100 pullback risk, is the fact that financial investors, non-central bank, like the public sector financial investors, has actually started to come back into the ETF despite the fact that it's at all-time highs, like the price of the ETF.
Yeah, and I was thinking, when you think about investing in gold, how do you think about doing it through gold futures versus an ETF versus physical gold?
We tend to go for the easiest source of execution, which happens to be COMEX gold. Now, that's an interesting question lately because of the introduction of tariffs. There has been a basis market for gold where gold was not actually trading at the same price globally. Normally, it's in a very tight range. It's totally fungible. Yes, the gold bars are a different size in some locations, so you have to melt it down and resize it. But that's an easy process, with the exception of the pandemic where those plants were closing down and you couldn't move it around. It's not difficult to make gold fungible globally. But tariffs have challenged that now too. And the fact that there was some fear that there'd be a tariff put on gold coming into the US, which caused some dislocations between what I would say is the more easily traded COMEX contract and the more OTC gold locations globally. So that's a consideration you want to look at. That has largely been priced out now because gold has been exempted. Outside of that, we tend to just trade COMEX because it's the easiest. I think there are physical buyers out there. We're not a physical buyer. I've heard in the past people will do that because, yeah, that's real fear factor. Like, I actually want to know the gold is in my own vault or my own safe somewhere. If that's where the world is going, I'm not even sure, borrowing gold is going to be your top concern.
I wanted to ask you because, at Quantix, you also look to create alpha for investors in the gold market and the other commodity markets. Like, are you seeing any interesting relative value trades in gold or other types of trading strategies that have become appealing in this environment?
Well, one thing that's related to what I just talked about in terms of tariff factor is that because COMEX gold was starting to trade at a premium, with the idea that if there's a tariff charge attached to gold, it's going to be more expensive in the US than it is globally. prior to that tariff ever being put in place, just the fear of the tariff was creating a differential between the COMEX price and London gold. While before there was any tariff in place, which is incentivizing massive amounts of gold to be sent to the US because they're like, wow, there's no tariff yet. I can buy it here, ship it there for less than the differential, sell the future, and just deliver in. And quite a lot of that actually had occurred over the last several months, which means COMEX gold inventories, like those that are on the COMEX exchange, have exploded. And that gold needs to be financed. Somebody needs to be paying for the fact that that's just sitting in COMEX vaults. Historically, investment banks have done that, but I think they've reached their capacity of doing it. And now it's searching for other forms of financing. And those other forms of financing are demanding a higher price in order to do that. So the contango between spot gold and the second or third nearby future actually has a yield to it that's higher than treasury risk-free rate. So yeah, that's an interesting trade, something we actually do for our investors, excess collateral for the cash management. And I think that's the sort of buyers that dynamic has been forced to find, like because investment banks that typically do it are sort of full on that trade. So it's getting a little better yield for people like us.
And I'm curious, how do you think that may play out given we've kind of got this large inventory of gold now in on COMEX that doesn't really need to be there?
I think eventually the world global inventories will renormalize because if you're not holding the physical gold, you don't want to be paying that larger carry. You might move it back. But for now, we'll take the excess yield and there's really it's a risk-free trade. Like if it does move back and the spreads tighten, you don't lose any money having done that. You just get to market the gain rather than having to carry it to expiration. I think eventually, yes, those spreads will come back to more normal dollar rates, but we'll see how long that may take.
And I wanted to ask you, kind of looking at the broader commodities, right? You've got an environment where gold's been going up and hitting new highs at the same time. You've got crude oil and energy falling. How do you think about, just the broader commodity landscape right now?
Longer term, not just gold, but other commodities have a better story than the rest of the 60/40 portfolio. And I think post the Rose Garden, you saw panic selling in everything. Even gold was down 150, $200 from where it was trading in the days leading up to the Rose Garden tariff speech. But you look at a day like today, yeah, equity markets are off 3%. And basically, I'm looking at my commodity screen, and it's a sea of green. I think, and it's not just gold. Gold obviously is leading the charge up 3.5%. But even oil and agriculture and base metals are all up today because I think investors are becoming a little more disciplined about where we might be leading with this. And what I think is supportive of the other commodities is not demand, because I acknowledge that a trade war is not super bullish global growth and consumption. But the other thing that was a characteristic of the low inflation periods of and global free trade was global free flow of capital. And that capital was helping resupply commodities everywhere. It was just encouraging investment in commodity supply, which I think is going to be challenging and quite tougher to get going forward. So the supply side story for commodities, I think, is over the coming years is going to be pretty interesting.
Wanted to get your wider perspective because obviously you've been deeply involved in commodities markets for a long time, partner at Goldman Sachs around commodities there. Does this current market environment remind you of any other markets environments you've been in, or is this a new thing?
Our former colleague Jeff Gurry, who definitely was keen to be talking about supply side lack of reinvestment, revenge of the old economy type story. So that theme has been out there at various points during my commodity history. I think this time it's a little bit different driver. It's the same theme, but the driver of that theme, we haven't had the potential for this much deglobalization and lack of free trade, lack of free flow of international capital, like in a century.
It's astounding. It really is. And how much do you think investors are recalibrating around that? Are they seeing this as like, oh, we need to make small changes, or is this like a broader rethink of asset allocation of the whole thing?
So I think investors are still in the shock phase. Like the policy ping pong has been so exhausting for everybody that I'm not sure enough investors have really thought this through to where the end game is yet. For now, they're like, I'm exhausted. I'm just moving to the sideline, which in and of itself is bearish. Like being on the sideline means you're not putting capital to work. But I don't think they've actively thought about, okay, I may never get to put capital to work, or I maybe never feel comfortable putting it to work, and where that could actually lead markets. So, I think the direction of travel still has a way to go on that basis.
So I got to ask you, are there any interesting opportunities or dislocations you're seeing across commodity markets outside of the gold market?
And we've been using the phrase throwing the baby out with the bathwater. As I said, that after the Rose Garden, everything went red. There's probably some things that didn't need to go red. Gold is one of them, which just bounced back very hard. I think another interesting commodity, actually one that is even down today, is natural gas. There is increased LNG that's trying to globalize that market, but largely it's still a geographically isolated market that should be relatively free from what's going on in the tariff war. It was a well-owned theme trade to be long back in nat gas because LNG supply is increasing. I think that hitting the sell button forced a lot of that speculative length out of the nat gas curve, but now we're at prices that are quite frankly below incentivizing reproduction while we actually have a demand off taker and increased LNG, which has already been committed. I think nat gas looks interesting right now.
And I was curious because everybody follows, the VIX as it went higher and higher and kind of understand what that means for equity markets. What does it mean when you get that level of VIX and anxiety? What does that mean for how commodities trade?
It's bullish long term because you start getting people thinking about a more diversified portfolio mix and some genuine diversification and desiring to get some uncorrelated assets in their portfolio. The immediate impact of it is similar to what we saw again after Trump's tariff speech was, sell everything. But as we're getting more clarity about what should really be sold and what should not be sold and where am I going to put dollars to work, I think it's already starting to show up that commodities are a beneficiary of a high VIX.
And I wanted to ask you, now that commodities and gold are getting a look from investors who may not have been giving it a look in a little while, what do you think an investor who's new to the commodity or, the commodity or gold space and is looking at it for the first time in a while, what do you think they need to know or what questions should they be asking?
I think they need to know less than they used to know, which is a good thing because if you go back to like when we started our careers, you really had to have a futures trading account, which very few investors did to really get access to commodities. I mean, one of the things that has happened with the advent of ETFs, they've made many asset classes more accessible in a safe way. I mean, there's professional managers that know how to trade these future markets and know where the implications of trading futures markets are and not having to get caught taking physical delivery of anything. That manager can take care of that for you, put in a wrapper that's more accessible to the general public. If you have an equity account, you can trade an ETF that can give you commodity exposure. And I think that's a good thing for investors to have it more accessible.
And last thing I wanted to ask you, going back in this podcast series, we've been talking about the role of gold in the 21st century. And I'm curious, what do you think the role of gold should be in investors' portfolios? And what do you think we need to do to make that point of view more mainstream than it's been?
Even relative to something like crypto, which gold often gets compared to, is it competing with crypto or not? I think the thing that is attractive about gold in general is just its longevity. It has been a form of value for thousands of years, far outdating any fiat currency. I think of this period where global trade dynamics are going such a violent and potential incredible disruption that the attractiveness of something that has been around that long should be pretty obvious to everyone. And that's how I would differentiate it from crypto. You could say argue crypto is a countryless currency too, but it does not have the longevity going for it that should give investors comfort. Like, hey, however this ends up, gold is still going to be around because it's been around forever. I can redecide what I want to use my gold with at the other side of the tunnel. But right now, while I'm in that tunnel and I don't know where it ends, gold seems like a pretty safe place to put your money.
Thanks again to Don Casturo, founding partner and chief investment officer at Quantix Commodities. We hope you enjoyed the episode. We'll be back next week with another episode of Gold for the 21st Century. We hope you'll join us.
This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter Markets are here. Contact us at sales@abax.exchange to get started. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.